Let's start with the accounting tutorial. So this is the prep exam that the guys wrote 2 years ago in anticipation of ITC 2018. They enjoyed it, and I hope you also enjoyed it as well. What it was meant to test more than anything was your understanding of the fundamental principles of IFRS. So you will have noticed that Part B, more than anything else, wanted you to identify the errors that were done and then say what should have been done. So it meant, one, you need to know your IFRS so well that if inappropriate accounting has been executed or has been processed, you are able, or you are in a better position to be able to call it out, but better yet, be in a position to do what? To be in a position to communicate what has been done. So a good follow-up or a question that you can also do in order to assess your competency in that regard is, I don't know whether that's the right name, Drumio or Dramio. So that is the ITC, I think that was ITC 2016-17. So I will also strongly encourage you to look into that, where they actually force you to pick up the errors from a bunch of information and be able to communicate them effectively. So another interesting element about this paper was the integration of strategy into financial reporting, which was essentially the last part of the required, where now we are saying that as an entry-level professional, you need to be able to look at issues from multidimensional perspective. So as much as this was predominantly an accounting question, you are still expected to be able to think about the issues that actually impact other aspects of what? Other aspects of the accounting world before you make a conclusion. So I will strongly encourage you to have your standard with you as we go through some of the detail so that you can be able to pick up what was expected of you. In terms of specific paragraphs, in some cases I don't have them, but I'll just direct you to the right place so that you can be able to flag and remember it for what? For going forward purposes. So now, what were we required to do? For the first side of it, it incorporated consolidation, where you are required to process a change in degree of ownership entry. And in this case, this degree of ownership or change in degree of ownership was effected through a share buyback. And remember that for ITC 2019, you will have share buybacks, but you will just not lose control through share buybacks. So this is still something that you still need to know how to what? how to process in terms of what has been done, and therefore what do you need to do in order to correct what the group wants to see. Then Part B, that is the major question, which required you to evaluate the 11 transactions that were processed and then be able to do what? Be able to pick up what were the errors and, better yet, advise on the errors. In terms of the mark allocation, there was almost a 60-40 split between discussion and calculation. So the majority of the marks related to you picking up and communicating what was wrong. Then, of course, in some cases, you will need to what? You will need to process the journal entries. So you will need to process the calculation, but the calculation were not the dominant thing. In some cases, you will find that the calculation was a straightforward calculation, but to get to that calculation, you needed to discuss about 5 things or so. Then, the last one, as I said, that was then a strategy question looking at long incentive type of awards. So, to get into it, we've got this company called LCM, which is a listed company that specializes in the manufacture of scooters. The company is based in Cape Town and was founded by Mrs. Charissa Mimawoga in 1985. The company experienced exceptional growth since its inception that drove the decision to list on the Johannesburg Stock Exchange, since it sought long-term capital for continued growth. The financial year end is 31 December, and the directors authorized the issue of the financial statements for the year ended 31 December on 31 January each year. Shortly before the finalization, however, for the financials for the year ended 31 December 2017, the accountant had to be rushed to hospital for a medical emergency. The only outstanding matter was the incorporation of the financial information of LCM, the parent, into the consolidated financial statement of the LCM group, meaning that everything on the other side has been what? Has been done. All we just need to do now is to do what? It is to incorporate a LCM. And that was an important point, because if you didn't pick up that point, you will not have, or some of the transaction will not necessarily have made sense, especially what? Transaction number 8. The accountants of the subsidiaries within the LCM group had correctly finalized the profit before tax of the subsidiaries to be 34.5 million before the consolidation entries for the amounts included in the separate financial statements of LCM. So you are not supposed to be worried about what? Intercompany transaction on the other side, but only intercompany transaction that or whose effects will be sitting in the P&L of the parent. So number one dealt with revenue and cost of sales. They showed you how revenue was calculated, which was also important for you to be able to pick up the marks or to pick up the errors. Then they went into details with regards to the cost of sales, which was calculated as 136,750. During 2017, the company sold a total of 22,000 scooters. The standalone selling price of each scooter is what? 7,500. And if we check that revenue calculation, we are saying that if they sold 22,000, we want to see 22,000 in the what? In the revenue figure. But we are surprised to be seeing 8,000 times 8,544 plus 22,000 minus 8,000 times the 7.5. So there seems to be some 8,000 scooters that were sold at a different price to the standalone selling price of 7.5. So we need to understand if that is the case, has that transaction been accounted for accurately? Then number 2, they then said the cost per manufactured scooter was determined as follows. 1, we've got direct materials, labor, variable manufacturing overheads, and fixed manufacturing overheads, totaling to 6,250 as the total cost of the scooter. And we know that when we talk about inventory, we are in IS2 in what? In the standard. So this was not necessarily a many question, and I think the feedback that the guys that wrote this paper said was they felt or they thought this was getting to be an integrated question from MENEC. And the idea was for you again to be able to see the accounting when you've got a management accounting component included in there. So MENEC, you needed not to consider it for the purpose of this, but you needed to be in IS2 inventories. Then they say the standard with regards to material, that's where the star is to manufacture each product using 45 kilograms of plastic material. During 2017, it was discovered that each unit utilized 50 kilograms of plastic material. So they've used more than the standard. So what does IS2 say about that? MENEC will tell us this is a variance and it's an unfavorable usage variance, but we don't care about MENEC now. We are caring about what? Financial accounting. So from a financial accounting perspective, what is the issue that they are testing here? It's what? Abnormal wastage. So what does the standard say about abnormal wastage? That's what you needed to pick up. What does the standard say about abnormal wastage? It has to be expense and not included in the cost of what? In the cost of inventories. So therefore, what you then needed to pick up is, did they include this? Because if they have, that is an error altogether. So we continue. After investigation, it was revealed that there was a problem with the manufacturing machine. A technician was appointed and resolved the problem a few days before the company's annual closure in December 2017. No further production took place in 2017 after the problem was resolved. It is now anticipated that in 2018, the machine will be operating in accordance with the company standards. Number 2, which is on fixed manufacturing overheads. The fixed manufacturing overhead cost of 350 is based on the actual total manufacturing cost divided by actual labor cost utilized during the period altogether. Does that sound like IS2? That sounds like IS2. Right? That sounds like IS2. But is that right? What does IS2 actually say? So IS2 allows this, but in particular instances. If you're thinking, MENEC, this statement is wrong, what will MENEC say? How do you determine your overhead allocation rate in MENEC? Budgeted cost divided by budgeted activity. That will be MENEC. So that's why I'm saying that you need not to be in MENEC, or you do not need to be in MENEC for you to look at this question properly. So from an accounting perspective, we work with actual. So the use of actual has no problem there. Then, the normal production capacity of LCM is 500,000 labor hours. During the year ended 31 December 2017, LCM manufactured a total of 20,000 units. So then my question to you is that when can you use total labor hours to determine your overhead allocation rate for the purpose of financial reporting? When can you and when can you not? When can you use actual total labor hours or total units manufactured to determine your overhead allocation rate for the purpose of financial reporting? When the actual activity is higher than the normal capacity, that is when you can use actual. So you needed to prove that really actual hours for the year were less than what? Were actually greater than the normal capacity of 500,000 for them to be able to use that. If that is not true, this is an error that you need to communicate and correct altogether. So 2 IS2 principles. Then they said to us, there was a total of 5,000 manufactured items on 1 Jan 2017 with a total value of 30.5 million. The company applies first in, first out policy on all its manufactured items. They calculated the cost of sales as 22,000 minus the 5, which was already on hand, right? Multiplied by the 6,250, which was the manufactured cost that they calculated on the other side, plus 30.5 million. Do you agree with that calculation? And if not, why do you not agree? Provide a brief explanation for your answers. So, how did you approach it? That is transaction number 1. So what did you do? Okay. So you've not started by disagreeing, right? Because you are required to proceed. You are required to go forward, not to argue what has been done. And it just says all the adjustments that you're going to make, provide a brief explanation. So you've got cost of sales. Do you agree with that cost of sales? No. So what is the right cost of sales? Give me your reasons. What is the right cost of sales? What is the right cost of sales?
I just adjusted the direct raw material.
What is first adjusting? What does that entail? It was inclusive of the abnormal wastage. Yeah. But what are you trying to do? Maybe let's start there. What are we trying to do here?
Correcting the cost per unit for the manufactured scooter.
And remember that it will be in 2 places. It will be in production and also in closing stock. So you need to be careful, right? So now, you are saying that you're going to calculate the 45. You're going to do what? You're going to calculate a cost based on the 3.5 and subtract that cost from the 3.5. Then do what with the answer?
I adjusted the total cost per unit.
You did what?
Adjusted.
What does adjust mean?
So for me, my answer was less than 3.5, so I added back the difference.
So you give me numbers. You took 3.5 minus.
So how I did it, I said, the 5, the abnormal, the 5 over the 50 multiplied by the 3.5.
Okay. So you got an answer of what?
350.
350. So 10%. Okay.
Then I said the material cost is 3.5 minus 3,500 minus 350.
3.5 minus 350. Yeah.
And then my fixed overhead are correct. So I took the 6,500.
Yeah.
I added back the direct material difference of 350.
To increase the 6,250.
Yeah. Because they deducted more.
That's why I want you to be clear whether you added or subtracted. So you added.
I added it.
So your logic of adding is what?
Oh no, sorry. I was supposed to deduct. I think I was supposed to deduct.
Okay.
Yes, I wasn't.
Anyone else? To take it from that. To take it from there, I mean. Let's be here first. So she's saying she took 5, which was the excess or the abnormal wastage, and she said 5 out of 50 times 3.5. It gave her the 350. She then said 350 plus 6,250 to get the cost per unit. Does anyone agree with that, or does anyone have a different view to that?
I calculated, I reduced the total cost of raw material by 7 million, which would be
7 million.
Yeah, it would have been 5 kg.
Yeah.
Multiplied by 70, which is a rate per kg, multiplied by 20,000, which is production for the year.
Okay.
So meaning my total production cost for the year will be less than 7 million.
Okay.
Meaning that would also be hard from my closing stock.
Okay.
And I took that 7 million and then I've expensed it as an abnormal cost for the year.
Okay. So that is the first thing that one needed to do, right? One needed to have abnormal wastage as the first thing. And the abnormal wastage is saying that you need to take what? You will then take 3.5, right? Times 5 out of 50, right? Times the 20,000 items that have been manufactured altogether. And you got 7 million. So then when you explain to the examiner the brief, when you provide that brief explanation, what was number 1? What did you see?
The total production cost for the year will have been overstated by the abnormal wastage cost.
Okay.
And then the closing stock will also include the abnormal wastage. So yeah, I was just doing calculation, not the time. I had it on my head. It's not written down. Yeah, but I get where you go.
Yes, because this is the point. The idea here is that you've got abnormal wastage, right? Being the excess usage above what? Above your standard. And IS2 says that all abnormal what? All abnormal wastage should be what? Should be expensed. So that is why you are doing that. That is the first thing. It's not the only thing, it's just the first thing that you needed to do. The entire abnormal wastage, none of it should be sitting in closing stock, all of it should be expensed as and when it gets incurred. That's in. Next. What do you do? What else did you do? What else did you do? Now tell me what you need to do. Let's not use this word adjust. Let's say you are adding, you are deducting.
Deducting which is what you were saying, the 350 from the 3.5, which is calculated by saying 3.5 over the 50, which is 7.
So direct material, we are then saying is 3.5 minus 350.
Yes.
Which is then the answer being what? 3,150. All right, then the direct labor is what? 1.8, we don't have any issues there. The variable manufacturing cost. The variable manufacturing cost is what? 600. And the fixed cost, do you agree with the fixed cost? That is the question. Do you agree? So, as I said, before you agree, you need to know what was the actual hours. So what was the actual hours? So actual hours was what? What was the actual hours?
450.
How do you get to the 450?
Take the 1.8 divided by 80 rand, and then you multiply by 20,000.
Multiply by 20,000. So this is the total cost per unit, and this is the hourly rate. Multiply by the number of units. So it gives you a total of what? 450,000. But normal is what? Normal is 500. So which one should we use to allocate overheads? Huh? Which one should you use? You should use normal capacity, because actual is less than normal. You only use actual to the extent that it is greater than normal. So now that actual is below normal, you use what? 500. So this is the problem they had, because they used 450, which was wrong. So we should have used what? We should have used 450. We should have used 500 and not 450. So now tell me, what is the impact of using 500? What should, or what will the 500 entail, the use of 500 entail? Tell me what will be, 1, the correct cost for fixed cost, and 2, tell me what else do we need to consider.
So I calculated, I used the 500.
Yes?
And I said 500,000 divided by 20,000.
500,000 divided by 20 to give you the hours per unit.
Yes.
Okay, you got the hours per unit.
And then I got the rate per unit.
By doing what?
I said 1,800 divided by 80, which gave me 22.5.
Okay.
And then I multiplied the 22.5 by 25. And I got my cost of 562.
So you did 1.8 divided by 80 and you got that 2, right?
Yeah,
225. And what did you do with the 225? Because that is what? What is the 225?
the rate per hour.
The rate, the labor rate per hour.
And
No, but it's given, the hourly rate is 80 rand.
It's hours per unit.
Or it's hours per unit.
Yes.
So you got hours per unit, but I thought you got hours per unit already by saying 500 divided by 20,000. What are we looking to do? Maybe let's take a step back. What are we trying to do before we do the calculation? What are we trying to calculate?
To get the total fixed.
You are trying to get the total fixed overheads. So what are you doing? So your process, so I agree we need total fixed cost. What is your answer? What is your answer? What is the total fixed cost? Let's just take a step back. 157 million. What do you have? What did you do?
They gave us 3 feet.
Yes.
And then they say they divided they divided the fixed cost of using the over 4 feet of actual hours. So if you multiply that.
Yes, that's why I was asking, because I feel that it's been overcomplicated, that you just needed to take that. To say that they've given you the hour, they've told you what they did, so you can just work back to say that, all right, if you had the total and you divided by this to get this, therefore this multiplied by this should be the total. So what is the total? 157, 500. Huh?
Minus the 0.
157. 500.
Another 5.
0.
00.
0. 3 zeros.
15 million.
No.
Another 0.
157, 500. Okay? That's my total fixed cost. Right? No, but wait. Is this right? No, this is the cost, sorry. This is the cost per unit.
A unit, so it should not be multiplied by 20,000.
This is the what? This is the number of hours. So these two cannot be multiplied together. So the idea is to multiply by what?
Get that 7 million.
To get what?
It should be 7 million.
7 or 70?
50 times 20 should be 7 million. 350 is the total cost per unit.
Yes.
20,000 units, so that's the total fixed cost for the
Yes. So you got 7 million being what? Being a fixed cost.
yeah.
Then what is the cost?
Can you please explain? Because here they say it's based on actual total manufacturing, fixed manufacturing cost divided by actual labor cost, which will be TC over my actual labor hours equals to 350. So if I total cost, fixed cost
Yeah?
over actual labor hours
Yeah?
equals to 350.
No.
That's what they say. The fixed manufacturing cost of 350 is based on actual total fixed manufacturing cost divided by actual labor hour cost, which is that formula then.
No, but yeah, maybe it's a matter of being technical with this. So if I say that,
350, then you can multiply them.
no, but I'm saying it's based on this.
Isn't that saying that it is total cost over the total fixed?
And then, that was not the intention. What do you mean? Like,
That's how I read it.
huh?
So I wanted to adjust the 350 because that's
Yes.
how I read it.
Because you now put it in a formula and say you're saying it's 350, then you do multiply by the number of
Yes,
hours.
it's almost saying like 2 is based on taking 1 and plussing another 1.
Yeah. It's a
Okay, just
Yes.
to ask, if we read
Yes.
it in that way, would it be correct to then adjust that
because
350
that's how I
rate
read it.
to reflect
Okay, wait. So, did they not do this? Did they not do this? They did, right? Then they multiplied by the hours per unit. Right?
That was supposed to be the case, but it was not there.
That wasn't, it wasn't.
Wait. This is, what are you saying about this? What is wrong here?
Yeah, they multiplied by, yes, hours per unit.
So, is the answer not based on this? Is that wrong to say that? Is this not answer based on this ratio? Huh? How would you say it? Maybe it's a matter of the how would you say it?
It was based on actual total.
Yeah, but I'm asking you the same question, that the answer that I'm going to get out is 350. So the 350 has been based on this.
Hours per unit it should be 22.5.
Huh?
Hours per unit is 22.5 hours, right?
Yes, which is what she had. But I'm just saying that, is that an incorrect way to say things?
No.
To say that this answer that you have is based on this. Is it not based on this?
It's based on this and the hours per unit.
Yeah, but obviously the idea is that this is per unit, right? But this cost has been based on this. So you needed this as a basis for determining the 350. Okay, so we are now saying that the total cost is now 7 million, right? Divide by what? By 500,000. Multiply by the hours per unit, which is what? 1.8 divided by 8, right? Which is 225. 22.5. And this is equals to 350. Is this not?
No, that would be on a normal capacity. We would have divided by.
So they already, yes, what they did was 7 million divided by 450 times 22.5. That is what they did. 350. The new answer is 315. But what they did was to say 7 by 450 times 22.5. Then they got the 350, which we are saying it's wrong. But the correct one is what? 315.
You know, if we use that method, we still get 315.
Which method?
The one I was saying that we just went like, which is 350 by 450,000, and then you divide it by the 500,000, you get 315.
Yes, you would.
Yes.
Yes.
Would we be wrong in our?
But did you start here? Remember that the discussion is starting here.
Yes.
So if your discussion started here and you said the use of 450 is wrong, remember that this is also a discussion question. It's not just a correct answer approach. So you have needed to say that the use of 450 was wrong. We needed to use 500 because it was normal capacity. Then the calculations were less of what an issue, as long as you get to the right answer. Are we together? So what she is saying is that she said 7 million divide by what? By 20,000, the units manufactured. This is?
It's not.
It's not.
We set it at 350 and we multiplied by the 450,000, then we got the 157.5, then we divided it by 500,000, and then we got to 315.
Yeah, but this is the same thing, is it not?
It's crazy, 7 million, which we didn't use in our calculation.
So you don't have the 7 million?
No, at all.
But you need it. Okay, let's proceed. So you've got this, right? So you got the correct cost now. What do you have as the correct cost? No, I mean the everything. So you've got the correct cost of each manufactured unit. Are we together? How much is it? 5865. So now we are saying, okay, let's talk about the impact of the incorrection of the overheads. So if you used the 450, it means you don't have over allocation. Do you understand? But in that instance, when we use 500 compared to 450, it means there's what under allocated. How much is under allocated? How much is under allocated? 50,000 hours has not been allocated, which is the 500,000 minus the 450 altogether. So you've got an under allocation expense. The under allocation is the actual cost of what? 7 million, right? Compared to what you have now allocated. How much have you allocated? You have allocated 315 multiplied by 20,000 units manufactured. Does that make sense? So how much have you allocated? 6.3 million. So how much have you not allocated? 700,000. What does the standard say about under allocation? It should be treated an expense. Under allocation should be treated as an expense. Do you understand? So we needed the 7,000 to be able to do that test. Right? Because we needed to know how much of the costs are underallocated, because when you've got underallocation, you also sit what? You also sit with an expense in accordance with IS2, which they've not done, these guys. Are we together? Then the last thing, what they've done is that they have expensed 6,250 instead of expensing what? 5,865. So they have an over expense as well. So that is just simply what? A correction. So the last adjustment will then be the correction. 1.3, the correction. And the correction is just saying that they used the wrong cost. So you are now comparing the 6,250 they've used minus the 5,865 altogether. Multiply by, how many units should we multiply by? Is it 20? Or should we take into account the closing stock on hand? The closing stock is what? So essentially, how much was the amount sold? 17,000, which is the 20,000 minus the 3,000 on hand, or the 22,000 sold minus what was in opening stock. Both will get you to the same answer. But that is just now to correct the mistake. It's not a matter of principle. The principles and the supporting discussion you will have done here. Does that make sense? So 3 things had to be considered. 1, they didn't account for abnormal wastage. 2, they didn't account for under allocation. And 3, they made an error with the cost per unit used. Altogether. That was part A. Questions? How well did you do?
The approach of the approach, the question was a bit confusing.
Which part was confusing? So which part would you say that caused you not to approach it this way? Or what did you expect? Mm-hmm.
More especially the discussion part, like, because what I did was to go straight to the calculations.
But the required told you to do it. So the required said, please note, provide a brief explanation of the reasons behind the adjustment you deem appropriate. Which, yes?
I think maybe it's about the split of months for discussion and for calculation. Because I know I was rushing it when I was doing it, but then in my mind, I just like a brief. To me, brief was just like a one line.
Yeah, and that's why I'm saying here that the keywords were this. However way you put it, I just want you to show me that you have identified an abnormal wastage. However way you put it. So even if you just say 5 is abnormal because it is beyond standard, that's why I'm saying that these are just the keywords. So brief, it has to still keep the key into it. So the question is, someone could have said that in 2 lines, someone could have said in 3 lines, but if you're starting to get to 3, 4 lines, you are going overboard or you're going beyond the brief part. What we just wanted you to see is that, are you clear that you identify the right thing? Are you clear that you've got an under allocation? And are you clear what does IS2 say about it? So that part, even if you had done the workings, your mind should have gone through that logic. And we just say, tell us the logic that you're going through. Are we together? So that was part 1, right? Part 2 then spoke about revenue. Remember that revenue has already been calculated on the other side. The 7.5, we saw that it was the standard selling price. So we are not worried about that, right? So we are worried about the 8544. So what is it all about? So they say to us, as of the beginning of 2017, all scooters sold by the company were subject to a standard warranty of 1 year. The standard warranty provides the customer with assurance that the scooters comply with agreed upon specifications, and this warranty is required by law. In terms of the warranty, if the scooter has a manufacturing defect within a period of 12 months from purchase, the customer may return it for repairs at no additional cost to that customer. Are we together? Then, we are told a maximum of 30 hours of repair hours is covered by the standard warranty, and additional hours is for the cost of the customer. As at 31 December 2017, 16,000 scooters were still under the standard warranty, right? Remember we sold what? We sold 17 new ones, right? So we are not worried about the opening because the opening one, the 12 months will have expired with regards to the standard. So we are saying that we sold 17 and 16 of them are still covered by what? By the warranty. So as a minimum, the 1,000 was sold in what? In Jan, right? And yes, it was sold in Jan or at the beginning of Jan. And as a result, by the end of the year, that warranty has expired. Some of them could have been returned during the year. So that is where the 1,000, we are saying that it disappeared to. But we are just noting it. Then they are saying that in 27, and then an estimated of 192,000 hours were estimated to be spent on repairing the sold scooters. In addition to the standard warranty, LCM offers customers an option to extend the warranty for a period of 1 year. And this is called the additional warranty. Customers who purchase this have the benefits of an additional 10 hours of repair time in the first year and 40 hours of repair time in the second year following the purchase of the item. So this customer essentially has what? A total of 80 hours covered of repair time.
So then I'm a bit confused. So the revenue amount ties into phase 2 as well?
Yes.
Yes.
This is where they talk about the 8544. In 2017, they offered a special pricing of 8544. That is where that 8544 was coming from part A altogether. Then they are saying, then based on the numbers there, we are clearly seeing that 8,000 of the scooters were sold with this special warranty or additional warranty. Everybody clear now? So that is how they got to that revenue. Then, during 2017, a total of 8,000 bundles were sold, so they even confirmed, generous. And no customer purchased the additional warranty on a standalone basis. It costs the company 20 Rand per hour to repair an item. LCM normally generates a markup of 40% on the cost of repairs undertaken for the benefit of its customers. The repair expense for the year was calculated as follows. Repairs in terms of the standard warranty, repairs in terms of the additional warranty, repairs not covered by warranty. Total hours, 181. Total cost, 3.6 million. This relates to the items for which the standard warranty repairs were fully utilized and the additional warranty was not purchased by the customer. 3.6 million there. Now, what is wrong? To give you the perspective, let's say 10 marks. For 10 marks, what is wrong?
From revenue side,
Yes, let's start. So from revenue, did they do right by saying that since we sold 8,000 bundles, multiply by the special pricing of 8544, is that in accordance with IFRS 15? Start there. Why is it not in accordance with IFRS 15?
there's true performance obligation.
So somewhere along your discussion, you needed to prove that there are two performance obligations. What is obligation number 1 and what is obligation number 2 when they sold that bundle?
The scooter and the warranty.
The scooter and what? The warranty.
Additional warranty.
The additional warranty. Why is the standard warranty not part of performance obligation? Because it's required by law. And the standard says if it's required by law, otherwise, if they did not specifically say it's required by law, were there any indicators that it was not any IFRS 15?
Yes.
What is the other indicator?
It's a short term.
So one, in relation to the term, it covers just one period. So that could indicate that it is actually not a performance obligation. Another indicator,
Assurance to compare with the agreed.
so it provides assurance that the item complies with agreed upon specification. So those are the 3 indicators that told us that this is not an IFRS 15 performance obligation. Where do we find these things that we are talking about? Are we guessing them or they are somewhere in the books? IFRS 15 in the appendix section, right? So it told us those are some of the factors that we need to consider before we say whether the warranty is a performance obligation or not. So that was part of the marks, to say that the accounting of the warranty, they are correct with regards to the standard, but they might not be correct with regards to the other one because it does not meet the what? The definition of a warranty in accordance with IS 37. Then what makes us believe that the other additional one is a performance obligation? What makes us believe that? How did you know that the other one is actually now a performance obligation?
For more than 1 year.
I feel you're oversimplifying it, but I hear you.
There's a longer term involved.
Okay? Because the customer can enjoy it on its own. What does the standard say? How do we know that the additional warranty is a performance obligation? Huh? How do we know? The customer has the option to purchase it separately. So the standard says if the customer has the option to purchase this individually or as an addition, then it is a performance obligation. That is the standard. So those were the highlighters altogether. So good, you have identified that there are 2 performance obligations. So now if there are 2 performance obligations, what does the standard say? What does the standard say? What does the standard say if there are 2 performance obligations? Where do you go in the revenue steps? So the transaction amount of 855 has to be allocated to the two performance obligation altogether. They didn't do that. And furthermore, what else do we need to consider about this two performance obligation? When should revenue be recognized? Because if revenue can be recognized immediately, then there is no problem of recognizing 8544 immediately. But was there a problem with recognizing 8544 immediately?
Yes.
Why?
Because the performance was only going to be satisfied after year end, over the next period.
So, one could argue that one was a performance obligation at a point in time, whereas the other was a performance obligation over time. So therefore, the recognition of the entire revenue today is inappropriate. Because the other one, they've not satisfied their performance obligation, they've not transferred the control of the additional warranty. Since they've not yet what? They've not yet worked for it altogether. So that was the main issue here. So now let's go. How much revenue should be allocated to the scooters? And how much should be allocated to the what? To the additional warranty. How much? What is the principle of allocating? We allocate on standalone selling price. What is the standalone selling price? 1? Huh? No, I mean, what is it? Let's define it. So we allocate based on standalone selling price, which is what? The external selling price of the item. All right? Then, do we have the external selling price of the warranty? And do we have the external selling price? I think so. Okay, what is it?
They've given us the cost per hour and the markup of 140% on the cost. So you can get a cost per total hours, the additional warranty.
So is that the standalone selling price? Is that the observable market price of the repair cost? No, so the standard says if you don't have the observable standalone selling price, you need to use what? You need to use what? Go to your standard case. You need to use the cost plus margin approach. So it is actually the second approach. But they are saying that you need to clearly state that this is not generally this observable price, but it is actually their cost plus a standard margin that they charge. Is that clear? So that is what the standard says. It says that 1, you can use the standalone selling price, or 2, the cost plus margin approach, and lastly, the residual price approach. So those are the approaches that it uses. So we've got here as the standalone selling price of what? Of 7.5, right? Multiply by what? Remember that this calculation works in total. So you'll then need to say what? 8,000, being the number of scooters sold altogether. Then they said to us, they charge 20 Rand per hour, multiply by what? Multiply by 1 point? Multiply by what? How many hours do you get entitled to? How many hours do you get entitled to? How many hours do you get entitled to if you buy this additional warranty? Huh? It's how many? 10 plus 40. So it's 50 altogether. So the standard loss selling price 7.5 times 8,000. Huh? 60 million. Then 20 times 1.4 times 50 times 8,000. 20 times 1.4 times 50 times 8,000. 11? 200. So the total is 71,200, right? That is what you will needed to pay to get these two. But what were the customers paying? So consideration was 8544 multiplied by what? 8,000, which is? How much? 83. 68.
68,352.
That's right. Oh. So, customers were supposed to pay this, but they got this as the consideration. Do you understand? So they got this at a discount. So as a result, you need to allocate this consideration to the two performance obligation. So how much will be allocated to the scooters? How much will be allocated to the scooters? So you'll then say 60 divided by 71.2, right? Multiply by 68,352 million. Okay? And how much will be allocated to the warranty? It'll be how much? 112 divided by? How together? Then you argue there's no problem here. So even if you don't calculate this number, there's nothing to adjust. The recognition of this amount in revenue is correct altogether. You are just worried about the recognition of what? Of the warranty. Is that clear? So how much is the revenue allocated to the warranty? 5, 7, 600. 5 million. Is it like this, right? 5 million, 5.7. But this is 11.2. I'm not understanding what you're saying. Yeah, but I'm saying that we are not worried about this. No adjustment that needs to be done. So don't even calculate it. Because remember that the question is asking you to adjust. So now we are just calculating for the warranty. 10. 800. Like this. So this is the revenue allocated to the warranty. Does this make sense? This is the revenue allocated to the warranty. How much should have been recognized and how much should have been deferred? So now you are here, you've calculated the amount allocated to the warranty. Based on the facts, how much should have been deferred and how much should have been recognized? So think carefully about the facts. How much should have been recognized and how much should have been deferred? 35,000, which is what we've done during the year, right? Okay. So we have worked a total of 35,000 hours during the year. Divide by what? By a total of 50 times 8,000. So this should have been what? Should have been recognized. Does that make sense? So this should have been recognized. And the balance should have been what? Then the balance should have been deferred. And therefore the deferred has to be adjusted out. Do you agree? Because they've included the revenue that should have been deferred. Now we are saying remove that as part of your revenue calculation. Are we all clear with the logic that we followed to get there? Are we all saying yes? Then, do you agree with everything that has been done to the repairs expense? No. Tell me, why do you not agree? Are you not believing that calc there?
It's in the generation.
It's in the generation. What do you mean it's in the generation? Yes.
With the provision, because if we were to raise a provision, we have to expense, and then that will be based on the cost that the entity will incur. So that would be the expected hours multiplied by 20 rand per hour.
Good point. Do we all see that? So in IS 37, if you've got a obligation, present obligation, which is what they have here, because they've made the sale transaction and they promise to fix the items, right? So if now you've got a present obligation, the standard wants you to recognize a provision at the end of the year. So these guys are saying to you that they are still committed to honor their what? To honor 192,000 hours against the sold units altogether. So they need to provide a provision for the 192. So they will then need to say, what is the cost of fulfilling that performance obligation, which is 20. So the journal entry will then be credit provision to recognize this liability, but debit repair expense altogether. That is what you will have needed to do. So the repair cost was understated. Are we clear? Which part exactly? Yes, which part of provision do you not believe? I want to know which part are you not believing? Everything. Everything. Like, yeah, that's why I'm saying which part, the debits and the credits. The what? The present obligation. That part. But you've got a warranty which you said that it's by law. So you've got the obligation to fix my stuff. Do you agree with that point? When are you going to repair my stuff? In future, but when? When are you going to do this? Tell me the month. When are you going to do this? A provision is a liability of uncertain timing and or amount. So one, we don't know when we're going to do it. We just know it needs to be in the next 12 months. And two, we don't know how many hours are going to actually be done. So it meets the definition of a provision. So if it does meet the definition of a provision, since there is a present obligation, since you sold these scooters and made a promise against it, then what we are saying is what? What we are saying is that you should have done what? Recognize this liability. Because you have a provision. You have a provision to repair. Therefore, it raises the expense today. That is what that journal entry is doing. So therefore, when you were discussing, you needed to prove to me that we have a present obligation. And therefore, we needed to recognize a provision as a liability. Yes?
I don't understand why the 192 is going through profit and loss then. Because what happens when it actually occurs, the expense?
Yeah, it doesn't go through profit and loss again.
So what's the journal entry when it actually occurs?
I should be asking you back.
Because I would have
Yes.
like I would have said credit provision,
Uh-huh.
debit accrued expense.
But you've got two liabilities and one is sitting on the debit. It's like creating an asset.
I don't know, because like
Uh-huh.
I don't understand why we're expensing something that hasn't occurred or being included or something.
So it goes back to why we need provisions in accounting to begin with. So we need provisions in accounting because there is a commitment to incur a cost that arose in the current year. And we are saying since the commitment to do something arose this year, then the cost of doing it, regardless of when it is done, it should sit in the current year. So when you actually execute, then there is no further expense. You have already provided because it arose from what you committed to in the year. So going forward, when the customer comes, you will probably need to pay your employees. If you're going to pay them, it will then be debit provision because you no longer have an obligation. Credit bank since you've made the payment out. Do you understand? So that is the idea behind it. So in future, no more expenses relating to the cost of repairing these scooters. All the cost arose in the current year because you made the commitment to repair now. And therefore the expense should sit now. In future, there should not be any additional expense. And the expense, if there is, should be just above that provision amount. Are we all clear, guys? So that is the logic of how provisions work. Make sense? Questions? 3, do you have a problem there? No? Then 4 will take us to break. 4, yes.
Now at a present value because it's longer than
You could have argued that, but remember that the idea is that you didn't have enough information of what was expected to be incurred beyond the 12-month period.
because they say it's 10 years and 10 hours for the first year and it's
Yes, that's why I'm saying that technically you needed to present value what will be sitting in 2019. But it's sitting in 2019, we didn't have enough information to know how many hours related to some things that will occur in 2019 or so. So one could argue that this is the best estimate we've got, and the standard allows for you to use the best estimate at the reporting date. But if they were really accurate, they would have said that 10 hours are expected to be used in Jan, and 20 hours expected to be used in Feb 2019, and so on, and we'll have the ability to calculate that. But given the facts, this is the best information we've got.
I think that's for the additional warranty. Because the 192,
Oh yes, we're talking about this, yes. Thank you for correcting me. Yes.
it was not long term.
Did,
Not long term.
yes. Thank you, Philip. So that is then why you will not do that. So I was thinking the additional warranty as well. So the additional warranty, no provision for it. The only thing you do is to defer the revenue. That is the difference between the two. Is that clear, guys? So 4. On 1 Jan 2012, LCM erected a factory building at Herriotdale at a cost of 12 million. In terms of then the existing legislation, the company was required to demolish the building and rehabilitate the land at the end of its useful life of 20 years. On 1 Jan 2012, the present value of the estimated cost to demolish and rehabilitate was 350,000, based on an interest rate of 10.10 so on per annum. So they've calculated the number for us. How generous. On 1 Jan 2017, The total useful life of the building was reduced from 20 years to 17 years because of the decline in demand for the products manufactured at the factory. Which standard is triggered by that statement? IFRIC 1. Changes in dismantling, provision, and rehabilitation cost. Are we together? So IFRIC 1 is triggered. So if IFRIC 1 is triggered, what does IFRIC 1 say? What does it say? So you've picked up that it's triggered. What does it say though? What does it want you to do? It will demand what? Step 1, what will you do if IFRIC 1 is applicable? So you're going to have a new present value. Then what do?